Did you know that you possibly could be writing off going to the movies, going to concerts, or even plays? I'm here with Jake and Scott, and we're talking about taxes today. This is for filmmakers and other entrepreneurs that are in the entertainment business. I'm basically going to be asking these guys all of the tax questions that I had all my freelancers and friends gather together these last few weeks. Before we start though, go ahead and get online and subscribe to us if you want to see more videos like this. Click that notification button. And follow us on Facebook. We're going to be putting out some more educational videos on how someone can start a film business and how someone can actually keep their money legally and not give it all to the government. I want to introduce you guys to some friends of mine. This is Jake.
Hi.
Jake Randall. He is the CEO of Taxbot. It is a tax tracking app. Do you want to talk a little bit about that?
Sure. Basically, we built this mobile phone app for people like you, independent contractors or self-employed people, to track your mileage, your expenses, and your receipts for tax purposes. So that way when the year ends and you've got all of your stuff, you can download a report and then deliver it to somebody like Scott, who can actually do the tax work for you and make sure you keep as much of that hard-earned money as possible. So we try to automate the whole process and keep you out of trouble with the IRS.
We've known each other for how many years now? Almost 20 years?
Almost 20.
But I've produced a lot of his Taxbot commercials. So we got Taxbot, now we got Tax Scott. This is Scott, he's my accountant, and he's actually helped me out a lot, get me out of a few little binds. But let's talk about your business, Scott.
Okay, our firm is, we have about 15 professionals in our firm. It's a little smaller firm, but so we can give a lot of the personal effect. We deal with a lot of small businesses. So we ourselves are a small business, so we deal with a lot of small businesses and know what they're going through and help them. It's from registering their company to get employees, doing the bookkeeping, and they get a little bigger. We become their controller and CFO, and we're experts on the tax side. I myself was an IRS auditor years ago. Left the dark side, came to the light, and here I am now with a partner in a firm, FJ and Associates.
That's great. And Taxbot as well, you guys have a book, right?
Yes, so we have a little book that we give away. It's called 7 Simple Ways to Legally Avoid Paying Taxes. It's just a really short synopsis that gives you some ideas on what you can and can't write off, some basics on getting your business set up so you pay less in taxes, okay? We do a lot of educational stuff too. Here's the thing is we try to help people understand that because they need to get more out of their accountant. The problem is most people treat their tax accountant like a gym membership if they're trying to lose weight or New Year's resolution. You know, they buy the membership, they're gonna go, and they go for like the first week in January, and then they fall off the wagon and they don't go back to the gym again, right, until next year. And they shouldn't do it like that because most people will go a whole year without talking to their accountant. And that is where they're losing money because there's a difference between tax planning, which is where all the money is saved, and filing your taxes. And most people don't get what they could out of their tax preparer because they treat it like a gym membership.
Oh, I agree 100%. It's kind of I kind of see myself as a once-a-year bartender a lot of times on that side, and if it's a lot easier to do it as they're going along as opposed to after the fact.
Yeah.
But why are we talking about taxes? Taxes is like, it's the nature of the beast part of any business, and we're in the film business, and so we need to understand this, but it's boring in a sense. But I go to these guys to help answer any of my questions because as I've gone along and I've talked with people on set or some of my friends, I've gotten kind of mixed reviews in a way on what I can and can't be writing off on my taxes. Someone says you can write off movies. Someone says you can write off this. So we've composed a bunch of questions here just to kind of grill these guys and to get their hard-earned knowledge on this. So I've sectioned it out. We're going to approach each section as if you were a film producer, freelancer, a musician, or someone having a full-time business or on the side. We're going to do another video about how to start a business if you want to get into the film business. But let's talk first off, what's the benefits of starting a business versus writing stuff off just personally? So your firm handles that a lot. Let's just...
Yeah, one of the question is when do you start your business and when do you just do when you work for somebody? Or the thing is, whenever you start a business and your intent is to make money, that is when you start writing things off.
Okay.
And take advantage of things right from the beginning, because a lot of times when you're starting a new business, there's not going to be a whole lot of money made because you're going to be buying a lot of equipment and traveling and getting things set up. So there's really... so you can take advantage of those expenses to go against the money that you're bringing in. So hopefully that you build that great foundation and how to do things, and if there's estimated tax payments associated with that, you don't get behind. Because we come across a lot of businesses that don't pay their estimated tax payments that first year. They figure, okay, I'll pay them when I start doing my taxes this next time, and they're a year behind. Okay. And they're trying to play catch up. And that's one place you don't want to be with the IRS, because, again, you don't want to ignore them. It's when you receive those IRS letters, you don't ignore them. You got to get them taken care of. But there's this industry is like any other industry, any other business. You got to treat it like a business, and because your idea is to make money and to provide a living from that.
Yeah. And I would say, add to that, I think most of the people we're talking about, I think they think that there's this line where they're going to go and they're going to start a business, but the truth is most of them are already in a business. Like, you don't have to go register your name or with the state to become a business. If you're collecting money for work that you're doing on set, you are a business. And so whether you like it or not, you're already in it. And there's usually not that, I mean, sometimes there's like an idea or a moment where you decide, well, whether maybe you should incorporate or become an LLC or do something like that. But the truth is most of you are already businesses, you just don't know it. And so you're leaving money on the table by not leaning into that and getting the tax advantages.
And you can suffer for that. I mean, we made a feature film and we got audited on our property tax and a few other things, and it kind of took the wind out of our sails a little bit because it was so detailed, and it sucked because you had given me access to your tax tracking app, but I wasn't using it when we were making our film. But if you want to set up your business, or if you want more questions about that, Scott would be the guy to talk to. His business helps set up a business. You guys helped me set up one of my businesses super quick. So, this is cool. I think we've said business a lot. Here we go. We're going to talk about gear. This is a section on gear. I think down below in the comments or something, I'm going to kind of section these out if you guys want to skip ahead or anything. But let's do our first question about gear. So does it work in our benefit, guys, to buy or rent? How does that affect us?
Well, I'll take a stab, and then I'd love to. I mean, in most cases, if you're buying equipment, here's the thing: it's beneficial to you if you're using it for business. Okay, a lot of people make the mistake of understanding, like, if you buy some gear, and you use it like 10% for your business and 90% for personal, you only get to write off 10% of it. Does that make sense? Like, it's got to be a business tool. It's got to be necessary for your business. And so that's kind of the thing with most equipment and things like that. It's the business usage of it. So I know a lot of like people will buy a camera, thinking I'm a filmmaker, so I'm going to buy this camera, but they're not really buying it with the intent to make money with it. They're just trying to look for, some sort of write-off. So the answer is yes. Now, in my opinion, if you're going to be using it for business, it seems like you're almost always better off buying because you get to depreciate the cost of that, and you have an asset. But I'm in that specific vein.
Yeah, I'd just like to add, when buying versus renting, a lot of it depends on what your intent is long term. If you plan on using that equipment for a long period of time, yes, buy it. But if it's just going to be if you have a specialty equipment, you're going to use it just here and there, you want to rent those things.
That's true, like an expensive lens that you're going to just use for one shot.
You need to run this like a business because your whole idea is to make money and have a profit. And so you can keep growing and bring more money to you. But, of course, you want to lower the taxes as much as possible as well in the meantime.
Yeah. So when you buy like in your app, how would you categorize that? Like if I bought a camera, or if I bought like a tiny little Osmo Pocket, and I use that for time lapses as I'm shooting documentaries or anything like that, how do you write that off?
So you want to document the expense, right? So
Okay.
you purchase, you have your credit card or whatever, your receipt, snap a picture of the receipt and categorize it as equipment. Now, when it comes tax time, you're going to sit down and meet with somebody like Scott, and you're going to like determine how that's written off. Okay. So there's two events. There's the purchase of something, and then there's the figuring out how it's actually been written off. If it's a big purchase, I would actually talk to your accountant before you buy it.
Okay.
If it's a really big purchase, but because there may be he might be able to find some guidance there. But the filing is where they get into breaking it down. Maybe you want to talk a little bit about that.
Yeah. Put them in a category like equipment in your expenses, and then pretty much things that are under $500, you can expense those in that first year. Everything above that, there are certain tax elections you can take, and you can still write those off in the current year. But you can depreciate that over several years. It really depends. We look at the individual, the business, and find out what is best for them.
Okay. So, in renting, is that fall in that same category, or is that if it's $500 or less, or is it like if I'm doing a shoot and I need to rent a camera that's $600 a day and I'm doing it for a week?
Rent's easy.
Rent's
Rent is an expense. Rent's rent. It's an expense.
Because I mean, it's cheaper. Like in the end, you spend $50,000 on a super awesome Hollywood camera, or you can rent it for like a day for $600, right?
Just an expense, just straight off.
I know Hollywood as well. I mean, most studios just rent, and I think that has some tax.
Yeah, you write like it was mentioned. You write off that year, and really, most on a lot of these high-end pieces of equipment, it's probably best to rent because technology is always changing.
Yeah. Well, that's cool. So it's easier to write off if you rent.
I mean, easier is a strong word. I mean, but it's going to be straightforward is probably the right way. Like if you rent something for $600 that you use, then you just expense $600 and it lowers your taxable income by $600. If you buy something for, let's say you bought that $50,000 camera, then you're going to probably write that off over a period of years.
Okay.
So you might write that off over, I don't know what the depreciation schedule is for a camera, but let's say it's 5 years.
So each camera would have a depreciation schedule? I didn't know that.
Different equipment has different schedules that the IRS kind of lumps them into.
Like a computer as well? Like a large computer?
Yeah, like a computer would have like, you would probably know this better than
3
Scott.
years.
3 years now,
Yeah.
right? But a car is going to be more like 6 years at the most.
Yeah, they're 5 usually.
Five and a half usually.
Depends
by
on
the time
depends on the vehicle itself.
Yeah.
So I work full time. Is that why every 3 years they switch out my computer?
No, you just destroy them that quickly.
But like Scott said, like especially if you're like a startup and like money's important, right? And you're trying to offset some income, like there are elections that you can make. So you could potentially write off a $50,000 camera in 1 year.
Exactly.
But you want to see what the tax ramifications are.
You want to make sure there's income to offset that,
Right.
Because you really don't necessarily want to have a loss all the time.
Right.
That's just crazy. See, and that's why you need a guy like Scott to kind of help you with those expenses. So finding a good accountant, Scott's a good choice. So if you're a musician, I have a friend that's a musician who sent this question. If he buys a guitar, an amp, or something like that, maybe he's traveling with it, keyboard purchases, can those be written off?
If he uses it for business, yes.
Okay.
The IRS code pretty much states out that if it's ordinary and necessary. So in this situation, that's ordinary. If he wants to go up and play, he's got to have a guitar and an amp. So that's ordinary, and then it's definitely necessary for him to make money to have that piece of equipment.
So if you're a guitar player, one more excuse to tell your wife or your husband that I need this and I can write this off, right? But they need to be a business though, right? Set up as a business in order to write something off?
Not necessarily. There's different levels, as was mentioned earlier. You can start right up day one when your things are going. It's based at a sole proprietor.
Okay.
On the tax returns, a Schedule C. It's the easiest, simplest way to do it. Tax-wise, it's the worst. So easy is always the worst, of course, from tax side. And then you can do a limited liability company. You can do an S corp or corporation. LLCs can also have an S election. There's really, before you do any of that, you need to sit down and talk to somebody and really figure out which is best for you, because the dynamics of who the owners are and what you're doing, the business you have, can determine as to which one of those entities is best.
We're going to do a video about, what's best for you business-wise, and we'll have that. So keep following us.
I was going to say, like, I think it comes back to this concept of if you bought it with the intent to make money with it, you're in a business, right? But if you buy it thinking, hey, maybe one day I'll play a concert, but you're not actually actively pursuing playing concerts, then you're probably not a business, right?
And that's when it's considered a hobby.
And that'd be a hobby, and then you're not going to get the write-offs.
And then the hobby, with a hobby, there's hobby losses, but you can only take losses up to the revenue, so you can't actually have a negative on those.
But the point is, like, if you're an active musician playing concerts, or you have a booking or something like that, or you're actively seeking that out, and for money, right? Not for free. Not like, hey, I'm going to try to play as much free open mics as I can. That's probably not a business. But if there's like an exchange of money happening, you're a business. And so you don't have to like go register. You should, because there's, like he said, there's better things you could do. But most of you are already in a business. You just don't know it.
Yeah, because the IRS code actually talks about hobbies and businesses, what the differences are. And really the main thing is what the intent is.
So I have a buddy who sent this in. He basically said he's been told by one accountant to buy gear at the end of the money, so he will save on taxes at the end of the year, to make sure that all goes in on that year's taxes. And then on the other hand, he's also been told that buying gear is not a good idea because he's going to end up paying more in taxes. So I guess his question is, which is it? He's been told two different ways from two different
both.
people.
Yeah.
It's really both. It really depends. Depends on the situation. For example, I have a client that came to me and said, here, I want to buy a new truck to decrease my taxes. And I asked them, were you going to buy that truck anyway? Well, no. Well, then don't buy the truck just to save taxes. Because tax-wise, you might be saving 40 cents on the dollar. So I spend $1 to save 40 cents type of thing.
So if you need the equipment, or you can use the equipment, if you already like want a truck or something, or you already know you want this new camera and you want that for your business, then yeah, it makes sense sometimes but only if you're already showing a bunch of income, right? Because if you're already like not making money that year and then you go spend a bunch of money, it's not going to really help you out that year. You kind of want to buy equipment or go double down on something like that if you're going to show a lot of income, so you're going to pay a lot of taxes, and then you want that equipment anyway. So then that's a way to lower your taxes for that year and get that equipment now.
And that's what goes back to why you want to have an accountant, somebody do some tax planning, so you can see where they're at towards the end of the year and give the proper advice as to what's the best for them.
Get an accountant, guys. If you have questions about any of this stuff, go ahead and put stuff in comments, and I'll try and moderate that and talk to these guys. I'm not going to have these guys looking at it, but I'll try and moderate that and hopefully get you some answers as well. But these are all the questions I got from all my friends. So let's talk about like software or subscriptions. There's software like Adobe Premiere, Final Cut, animation software, or even Pro Tools if you're a musician, right? Some of them are subscription based, like Premiere is, and some of those are, just write it off. Is that an actual expense, or what's? I mean, can you write all those off?
Yes.
So you buy
but for business, yes.
Okay.
Yeah.
If you're just if you just bought it to edit your personal photos, then no. But if you're like working on projects for clients and things like that, or for a thing, then absolutely. We bought it. We're not a film studio, but we bought it so we could edit videos internally.
Yeah.
So we wrote it off.
So
most expenses kind of come in 3 categories type thing. You have, it's 100% business. That's what the intent is, using it for it. Then you have your personal living expenses, and then you have what's in between, which can be used for both. Like a car, like some of these.
When you sit down with an accountant, you say, 50% of the time I use this plugin, but the other 50% of the time it's just for me, hobbyist.
Yeah, exactly.
Okay. So is there depreciation if I bought a really expensive piece of software, like back in the day when DaVinci Resolve was $500,000? Would there be depreciation there, or is there? I think it came with a console and everything, but I'm just saying, if there's a really over $500 expensive piece of software, is there depreciation there?
There would be, yes, because it has a life of over a year. Okay. If it has a expected life of that particular asset or software of a year or more, then it's depreciated.
Okay, so if you're not, so like Dropbox and some of those subscriptions as well, you should be writing off. Yep. All right, guys. Here's some money you can be saving. So we talked about gear. Now we're going to talk about education. This is where I think a lot of people write off movies, concerts, or a few other things because they put that under, education. So I have actor friends that'll write off a movie. I have, filmmaker friends when they go see a movie. Some friends that are part of the DGA that'll go see a movie and they'll write off their time there. So I asked you about this last year. What's the answer to that? Can you go to the movies, and should you be keeping your receipts and writing that off?
There's one profession that I know for sure that I would feel comfortable saying absolutely, if you're a movie critic.
Okay.
If you're a movie critic and you're going to a movie, your job requires you, like he said, it's ordinary and necessary. If you're going to review a movie, you have to see the movie. So in that case, I would say for sure you could write off your movie tickets. The other side, I don't know how you feel, Scott, but to me that's a little bit.
It's kind of that grayish area.
Super gray.
Yeah. If you're taking a spouse with you, the spouse definitely not.
Right.
If you're going to it and you're keeping notes on it, and actually and you're going to use that for what you do as a profession, I would lean towards yes. That's a
great point. Like if you're taking notes and saying, like, let's say you're an actor or a director, right, and you're trying to come up with some creative shot lists or something like that for your next project, and you're going and you're watching and you're taking notes about not necessarily what's going on in the movie, not like the plot line necessarily.
But like you see 1917 and you're just blown away about the camera work, and trying to figure out how they did something.
Yeah, use it as an educational standpoint. I think that's
taking notes. So you need to add that to the Taxbot app, right?
But if you're just going to watch a movie, and you actually could. I mean, you could classify something in there as entertainment.
Okay.
And then you could copy and paste your notes into the description within Taxbot, and you would have all those notes.
Proof if you ever got audited.
But if you're taking some other people from your crew and stuff like that, I would say yes. And again, it's entertainment. And the bad thing about putting entertainment though, you get 50%. Is that 50% of its tax is deductible, not the whole thing.
But if it's education, is it 100%?
Yes.
Oh, wow.
Yeah, so I'd probably classify it under education. But you could do the same thing under education. But yeah, the real thing it comes down to is intent, right? If you go to the movie with the intent to learn from that movie, and you show up and you've got your pen and paper and you're taking notes, then you're there for education. If you go, you're taking a date, you're not there for education, right?
Well, depends.
Right.
Well, if you're going to a rom-com, you need some help with the date, right? So, okay, musicians going to concerts. If you're going with the intent to learn from, Billy Corgan playing a guitar.
I'd have to learn who Billy Corgan is.
He's the Smashing Pumpkins.
Okay.
That's probably pushing the envelope a little much there.
Okay.
Yeah, because most of the time you're going to learn a little bit, but seeing somebody jamming on a guitar, you're not going to learn much.
Yeah.
Okay. I guess if you're going with the intent to look at an actor in a play, like a filmmaker, like sometimes I'll go watch a performer perform, and if I'm considering them for a part, would that be something that you can write off?
Yeah, because now you're going with the intent to see if that person is somebody you want to hire, which is going to make you money, or break you, or lose you money, right?
Yeah.
So the intent is I'm going specifically to, and you would want to write that down in some sort of manner. I went to this play because I was evaluating so and so because I'm considering them for the role of X in this production. The more specific you can be,
The more you won't get in trouble.
the more you will get in trouble, because that proves that's the proof of your intent.
So as a general rule for education, what can, like, I guess I have a whole bunch of questions here. There's a lot, but I mean, maybe we can cover them in just asking you straight up, what can you write off? What would be considered education? I mean, we have stuff for filmmakers like Masterclass Online. We have, that's a write-off.
Yep.
Anything that's built as like education that's either teaching you a skill or something like that in your craft would be, you could write off, unless we're talking about higher education.
Yeah.
Like your film degree is not a write-off.
Really?
Yeah.
Okay.
Accredited in education would not be a write-off.
It's not a business expense.
Not a business expense, correct?
Yeah, but there are some tax credits for that.
Yes, that's a good clarification.
That's something you would talk to an accountant about. Concert, movies, plays, If I take my spouse, you can't write off your spouse's ticket, but my spouse is my business partner.
Oh, good for you.
Can I write off her stuff if she's my business partner?
No.
Okay. So if you're an actor studying a role in baseball, this is an actor friend wrote this, and goes to a game, a couple baseball games, minor league, major league, you just write that down. I'm an actor, I'm studying these roles, I need to learn the rules of baseball, and I got to go to a couple games. You can write those games off?
Yeah,
Okay.
absolutely.
All right.
As long as you're not writing them off after you already finished the role.
Yeah.
If another actor question, if I hire a trainer to help me get in shape for a role, can I write off that?
I would say if,
I just say ask Sylvester Stallone.
yeah.
I'm sure he did.
Yeah,
You wrote all that off?
I'm sure. Yeah, because if your job is your persona and your ability to transform into the role you need to, it's ordinary and necessary to get a trainer. Right? Now, if being the CEO of Taxbot, my role is not necessarily to be fit and cut for camera.
But you are the face of town.
I am the face of Taxbot, but I'm not, like, my job is not to transform into a role. So it would be much harder to get the IRS to approve a trainer for my job than it would an actor's job who's preparing for a role.
Okay.
Does that make sense?
Yeah.
Do you agree with that?
I agree 100%.
Because if you don't, I will definitely hire a personal trainer.
This was another question. I know some friends that will write off Disney Plus, Hulu, Netflix, or streaming services, or when they buy DVDs and stuff like that. Is there like a percentage you could say? Like, say, Netflix, you're watching Full House like 50% of the time, but you watch The Irishman the other 50% of the time. Or
Well, sorry for them. They weren't watching Full House all the time to begin with.
There's bigger issues at stake.
Oh, yeah, exactly. Yeah. You need to see a therapist. No, it comes down to your office and your home.
Okay.
If your home, let's say, is 2,000 square feet and 200 square feet of that you're using for business, that would be 10%. So 10% of those costs you could take.
okay.
Yeah, it'd be, but it's generally like speaking like out of
Usually
the
not.
box. It's not really. I mean, I guess if you had like a subscription to, here's an example where it might be. If I'm a dentist, and I have a Hulu Plus or a Disney Plus subscription, so that the kids in the waiting room can watch it, I could write that off. Yeah. But in my house, if I'm using it for my personal enjoyment, you're pushing the boundary.
Yeah.
Okay.
Right.
We usually take that 10% for our clients. If
So you're doing
is,
it under the home office rules
Yes.
rather than as a general rule, the expense is not deductible. But maybe through a home office play. Like you couldn't just write it off as like, this is a subscription for my business.
Yeah.
But through a home office, that's a smart idea.
So let's jump into meals. My favorite part.
You're buying, right?
I'm buying that right after this. Before we get into the questions, maybe you guys can cover it. What can you can't usually write off with meals?
Meals is pretty much, it's, again, ordinary necessary for the business, but if you're just sitting at your desk and you order out, or just, no, because you have to eat anyway. If you're out of town on business, yes, you can take those, because that's what's taking you out of town is business. And again, it goes back to you only get 50% of that as well. That's meals and entertainment. Both of those are only 50% of the total cost, unless you categorize it something different, which we have a lot of clients that do. Maybe it's marketing or what have you. But on the most part is if it's business related. But if I'm in one town, and I go to another. Pretty close, I wouldn't be able to take that, and I had lunch at that time. But it's really if it's out of town, and because I have to eat no matter what.
Yeah. The other time is when you're using it to meet with potential clients or prospects or whatever. Like you're meeting with some. If the IRS regulations state that you have to basically answer the question, how will this meal benefit your business now or in the future? By having this meeting, and then you have to document like what you talked about during that meal. So if you and I went to lunch to talk about doing this, then we would, I would write down that we talked about the questions that we might do in this video shoot, and that we're going to distribute this film so that potentially Taxbot gets some business. Right? There's a benefit to me to doing this because some of your users are going to get exposed to Taxbot.
Yeah, good point. Yeah.
We do. So, like, if you were to do, generally speaking, like if you're going to a restaurant with a client, like it's 50%, right?
Yeah.
That's pretty much it. If you're doing something like let's say you're going to do a sales seminar, you're going to book out a room at a teaching workshop or something, right? At a restaurant, and you're going to like include lunch or something and buy lunch for everybody as part of something else, like an educational workshop or something, then you could probably lump that in with the event costs rather than as a meal deduction.
So like if you make a feature film or a short film and out of your business account you fed everybody that day.
If you're feeding like if you're feeding the staff or the employees, then you could write that off for sure. If it's more about they're trying to make sure that you're not writing off your own personal meals when you don't need to.
Yeah.
So always get donuts.
Always get donuts. Yeah. And you can write that off for everybody. Yep. And craft services, you guys know what craft services
absolutely, 100% write off.
Yep. Okay.
Because that's
craft services, set meals, write those off, keep your receipts, track them through Taxbot. So if I'm going out to eat to discuss acting work, the industry or anything to do with my work, can I write off that meal? Like if you just go with a friend but you're actually discussing it, like how much in a meal should you be discussing filmmaking, or how much in the meal should you be discussing?
Because like I think every meal I have I could probably write off. Yeah. It's like, 1041. Okay, it's all written off because I mentioned a tax thing.
You guys know what tax thing. Or someone asks you one question, you go out with a friend and they say, "Hey, which camera should I get?" I just like, let me tell you. We talked about cameras, right? Is that?
I think that there is the IRS understands that you are networking as part of business, right? So there's no set percentage like that you have to pay. We have to talk for 5 minutes or 50 minutes at the meal. Business has to be discussed, and it has to. If you're going by the letter of the law, it has to be predetermined before you get together that is a business that what you're gonna talk about. So it would be like me calling you up and be like, "Hey, I'd like to take you to lunch. We're both filmmakers. I'd love to talk to you about cameras at lunch and get your opinion on which cameras you're looking at for the future." If you know that you're coming and we're gonna talk about cameras, you're good. Even if we only talk for 60 seconds about cameras.
Generally, I've had some people that want to do like promo videos, and they've said, "I'll meet you for lunch and we'll talk about this promo video." And when they don't pay for that, it pisses me off and I don't want to work with them. It's like, you're taking my time, and I've gone to a couple business meetings. It's very rare. I mean, Jake, you've taken me to lunch a couple times. We've talked about potential movies, but like, if you want somebody to come, this is just a general rule. buy their meal. Do that. That has nothing to do with tax. You can write it off though, right? If you buy their meal.
Pay for their time.
Pay for their time.
It used to be that you could only write off 50% if you paid for their meal.
Yeah.
But the IRS changed their rules. Now you can you write off 50% of whatever you pay for. So even if you both go Dutch and you both pay for your own, you can still write off 50% of that meal.
Okay.
Where it used to not be that way, but it is now.
Well, I mean, honestly, it's just a general courtesy. And I think everyone has to eat lunch. And one of my professional buddies told me this, you can take people to lunch, and a lot of people are usually good at like sitting down. Everyone has to go eat. And it's actually a good way to do networking and put things together. So that's why I like it, because I like to eat out and try new things, but I'm also talking with potential clients and stuff. But
Scott, plug your ears. You want a really inexpensive way to get some consulting work out of your accountant? Take them to lunch, right? Or your attorney, same thing. You don't want to get charged $300 an hour for your attorney? Take them to lunch and ask
Ruth Chris all the time. Yeah. Anytime.
But there is also something really interesting about that too. Like, we're just kind of non-tax wise. You buy somebody lunch, they're more likely to do you a favor later.
moving into travel now. I shoot stock footage, and I went on a couple trips last year, and I got up early in the morning. The trip was a vacation for my family, but I got up early in the morning and I went out and I shot stock footage while I was on my trip. And I came home with 300 plus clips that I could potentially sell for my business. Can I write off the miles for that vacation?
If you were audited, the IRS would say no.
Really?
Yeah, because it goes back to what Jake mentioned earlier, what the intent is. Why are you going on? Why are you going doing what you're doing? Are you going out to do those pictures and just dragging your family along, or you can do it without them? You could take some of the costs. I would take some of those costs, but I wouldn't take the whole vacation trips.
The mileage though for your car, because it's not costing you any more to take your kids with you in the car, right?
Yeah.
So that's like one where they're not going to look at that and say, oh. The other side of that is that business a business and not a hobby? If you're selling those, if you put those 300 clips up and you're making good money, like more than the cost of that trip, right? And you have like a solid, legitimate, like, hey, I take these pictures and I make money, and there's like a clear like profitability there, you're gonna have a much stronger case than if it's just like, I'm thinking about starting. I haven't uploaded the clips yet, and I haven't made any money with it.
Yeah, if you take those expenses, it'd be expenses associated with you and not your family.
Yeah.
Okay, so like what about my meals on like a week trip? Like if I pay for myself outside of my family?
You would have to separate it for sure.
You'd have to separate it. You could do that?
Because your family would definitely not be like the case. If you have a good enough argument, then yours could be, right? Okay. If you're from a business, like if you're on a trip, like let's say you went to Hollywood, right? Because you're doing some stuff there, and you happen to, like, you had to bring your family along, and then you go do Disneyland and stuff. If you have meetings during the day, like you're meeting with studio executives and things like that, even if you have one meeting per day, those are business days, right? So your trip becomes fairly deductible. Your kids' stuff is not, but your piece of the pie.
And there's a great app for that too. Taxbot, right?
Yes, exactly.
So like if I'm on a trip, then I went down to southern Utah and I shot a whole bunch of stuff around Capitol Reef, but I just kept the Taxbot app, auto tracking everything. And I haven't classified those yet. I think I was back in May. I got a lot of work to do. But if I just left that on, since it's the whole trip, because we're going into the park, out of the park, to the hotel, out of the hotel, to dinner, from dinner, are all those miles, can you legally track all those miles?
If that's a business trip, yeah.
Okay. Well, it would be a family trip, but I did business while I was on that trip.
So, but the destinations, the mileage to business destinations is deductible. Okay. So your drive to get the photos, deductible. Your drive back to where you were coming from, deductible. You leave there to go to to dinner with your family, probably not, because you're not
but
going
you have to feed yourself, right? If you separated the
Yeah, I mean, there's probably an argument, but if you were going like way out of your way, like if you went like drove 150 miles to some destination, then probably not, right? Because you're doing that for your family, your kids, the experience.
As long as you swipe right.
Yes.
On the app.
Yes.
Yeah.
Well,
But it's all about I mean, the IRS isn't going to be there, right? To like look over your shoulder and be like, now did he really? but what they ask you to do is keep a good record. You write down the purpose for each trip, the business purpose. Why, so going to dinner, I'm on vacation. You would say, not on vacation, you would say I'm on a business trip.
On a business trip.
You would never want to say I'm on a vacation.
Well, you can say, well,
in your expense tracker, you would never say vacation. You would say,
on there, you would never mention your family. You just, I did this, and this is what I did.
Right.
What if your family were your models in the stock footage?
Where there's a will, there's a lawyer. If you were big enough, honestly, if you were a big enough production,
Yeah.
there's probably an argument to be made,
Okay.
right? And if you're paying them and they're employees, and you're actually making money, but if you're not making money and you're just like, this is just a big sinkhole for money so I can write stuff off, it's going to get totally disallowed.
Yeah, exactly.
So another person asked about location scouting. So can you write off, back to the stock footage thing, can you write off like a part of the hotel? Because you could be using a hotel to stay in these locations.
If it's a business trip, then and you're in a hotel room, then the hotel room. Now, if you have to buy a second hotel room for your family or whatever, then they don't necessarily need to be there. So I wouldn't write that off. Okay. But your particular it's kind of like driving the car. If it doesn't cost you any extra, then I would take what it costs you.
Okay.
Right. But if it costs you
personally. Okay.
Good point.
All right. Well, I did keep all the receipts from the hotel and stuff too, just because this is part of the reason why I brought you guys.
And he's making millions with his stock photo footage.
Now, I made a decent amount last year, but
no, just in case the IRS is watching, he's making millions.
oh, man.
I'm just kidding.
And he's hiding those expenses other places.
I've had some people write off, like they've heard that they're going to go film somewhere, let's say in Hawaii, but they've been thinking about going on vacation as well in Hawaii, that they're part of a production that's going to go film there. Part of that day, they would go and location scout, but the rest of the trip is kind of family vacation. So a location scout, obviously by yourself, you can write that off, right?
If it's part of your job.
It is part of your job, yeah. And just finding
if you're an actor,
right
you shouldn't be location scouting, right? So,
yeah. If you're the business guy or the location manager or somebody, if it's part of your job, you can do that. So you go with your family on a vacation, but it's also kind of a business trip. Can you write off those tickets, those plane tickets and the hotels, and then just maybe one day for the location scout?
It goes back to what you said earlier, is that yours, yes. The family, no.
Okay.
I mean, it's
Not the family tickets.
Not the family tickets.
Your plane tickets, though.
Yeah.
Because your family does not work for the business, it's not necessary.
There's no business purpose for them to be there.
So everything that you just, rule of thumb, business purpose, right? For you personally.
And then there's rules there too. Like there are some rules like where you could, little tip, you could take, if you're going to Hawaii, probably not practical, but you could potentially book a cruise and go to Hawaii from like wherever they leave out of Southern California.
Yeah.
But because you bought a cabin, the cost of the cabin, even if it's shared with like two people, could potentially be written off because you had to buy the cabin anyway.
Okay.
That's a case that's been upheld. You have to go by it has to go by a reasonably direct means, but it doesn't mean it has to be like. So you probably couldn't write off like all the party and stuff on the cruise, but the actual transportation.
And the gambling on international waters, right. Can't write that off. Okay. Guess I'll take that out of the gambling section we have here. Let's talk about. So I know someone that would say, I don't write off miles, I write off gas. What is the difference between that? Like, should you be tracking your gas receipts and writing off miles? Like, what does the IRS look at like for something like that?
Yeah, you have the choice to take the actual costs associated with your vehicle, which are any maintenance, gas, you have tires, insurance, any of that, anything associated with that vehicle. Excuse me. And then there's the standard mileage rate, which includes all those things. The IRS has come up with a number and included those things already, and determined those would be somewhat equivalent to those costs. If you have a newer vehicle, you probably want to take that, and you don't drive a whole lot, you probably want to take the actual costs. But if you have an older vehicle, you're driving a lot, it's definitely better to take the mileage. I have a client that he bought a little, one of his employees, a little truck. It probably paid $12,000 for it. He's putting 20,000 miles on it a year. Okay, in a tax deduction, the tax deduction on that would probably be around $11,000 on the standard mileage rate. But if he were to take the actual expenses, it'd probably be less than half that. Okay. So really, you have to figure out what works best in the different situations. But
as far as tracking, you actually need a mileage log for both.
True.
Because here's the thing: is if you're going to write off the actual expenses, during the year, just remember you got to keep a mileage log.
For sure, keep
a mileage log, no matter what. Because even if you're doing the actual expenses, what you're going to do is you're going to take, let's say you had $20,000 in expenses, and you drove the car 50% of the time for business, then you get to write off 50% of those expenses, 50% of the gas, 50% of the. If you drove 75% for business and you can prove it with a mileage log, then you write off 75% of those expenses. So it's a percentage of those expenses based on a mileage log proving how much you drove for business.
Is there an app for that?
There is an app for that. It's called Taxbot.
Taxbot is actually really good, and they actually have a detailed thing from where you start and where you end, and allows you to classify each trip. He actually has a Taxbot voice app.
Which maybe he can append in the notes for a film that he actually produced, a commercial that he produced for me.
Yeah, I'll put a link in the bottom. I did this commercial for Taxbot Voice where you can actually classify as you drive. So driving, let's talk about actors, let's talk about short films, feature films. If I'm making a feature film, I should track all the mileage for that, for a business. If I'm making a short film, if I'm an actor in a film, driving to an audition or driving to my performance in a film, I should be tracking all those miles.
Yep.
Track all your miles.
If you're driving to get costuming or something like that, track your miles.
Okay. If it all happens to do with you making money, track your miles. Okay. Driving to a meal for a business client.
Yes.
Okay. If someone's going to a destination, this is kind of falls in the same as like location scouting and something like that, but writing off plane ticket, someone's going to Dallas and he has kids in Dallas and he's visiting his kids, but while he's there, he's an author and wants to leave some books in different libraries down there. Can that trip be written off if he has set up these meetings?
Could he have mailed them as well?
He probably could have mailed them.
That's probably that's the stance that's where the IRS would come in. Could you have mailed those as well?
But the other side of that is if he had meetings set up where he could go and meet with them and say, I'd like to try to get my books in here. Here's a sample, but I'd really like, I'm in the area trying to do this, and he's trying to. If there's meetings that happen, because yes, a meeting could still happen over Zoom, but there's something about face-to-face meetings that you can.
You can write out the plane tickets and everything.
So you could do that, but that's the caveat is there are certain rules around travel, right? Like so you have to have a certain number of business days. Like if he goes down there and spends one day doing business and then 7 days with his kids, not a good scenario.
He could probably take half the cost. The flight there he could do, but not the flight back.
Yeah. Okay.
But if he like sandwiches those days and more than 50% of the days are actual business days, then he's probably good to write off the whole thing.
Yeah.
Okay.
So always do something business every day. Like you have a breakfast meeting or a lunch meeting every day.
Business every day. If you do something business every day on like a trip or a vacation, if you try and tie that
if you have
in
a meeting, a business meeting would qualify it as business day.
Oh, okay. That's good to know.
It can't be with your spouse. Exactly. Who's your business partner?
Can't do that. I have a friend who's technically a social media influencer, has an Instagram, and part of his gig is he basically he carpools his daughter and he does these funny things with the carpool. But he also gets paid now that it's considered an influencer, he also gets paid to advertise. Should he be writing off all of his miles, so carpooling his daughter back and forth?
When there's recording going on, I would say yes.
Yeah.
Because I mean, part of the gig is just doing these things. Not every time he does an Instagram story, he's not always selling, but every once in a while he'll get a sponsor, and then they'll say something. So should he just be doing it?
Well, his product is his show.
Yeah.
Right. That's what it sounds like. It's the show.
Yeah.
And if the show requires that if it's built on this concept of carpool, and he's recording and he's building up that's essentially he's building his audience so that he can plug product placement into it. So I would say in that sense, yes. If his show's not built around that and he could be doing that from his armchair and it's not that, then I'd probably say
Yeah, but he's carpooling 5 days a week and he's recording one.
one.
Yeah, so he would be able to take 20%.
Okay.
So not every day, but just the ones where the camera's rolling.
Days are rolling. And so every time you're rolling. That's cool. I didn't know that about Instagram and all that. So I've done a lot of free work for charity. Your wife runs a charity. I did a little bit of work for her. She ended up paying me in the end. But driving to do some of that stuff, you can write the miles off?
It's a not for business, but for on a Schedule A itemized deduction, yes. And it's 14 cents a mile.
14 cents for doing charity.
Yeah.
Now I would say.
So you would have to classify that as what, though?
Well, so let me finish this thought first. 100%, right? He's absolutely right. Now, if there's a opportunity for you to get publicity out of that, like for example, at the back of that video, it's produced by this and the Lucas and blah blah, and you're using that as a promo piece that you're sending out to clients, and like there's some real benefit to you using that as a calling card and growing your business, then maybe there's an opportunity for you to lump that in as not charity but as a business if it was
Like
if it's kind of a marketing thing that you're using, but you got to gotta be legitimately something that you're going to be using, right?
Okay.
But if it becomes like, hey, I produced this video, nobody knows whether you did that for charity or not, but you did it, like the viewers won't. But if you're like out there sending that piece out and saying, hey, I can do your charity video. Here's a charity video that I've done in the past. You should hire me as like a client sample. Like if you're just getting going, I could see an argument for that. I don't know.
Depends on what type of charity work you're doing as well. If you're going there to,
it would be for the filming in his case.
If you're going there to do humanitarian work,
correct.
It wouldn't.
If it's related to your business, you're a filmer.
Yeah. I'm a filmer, and I've filmed for a humanitarian group, and they flew me out somewhere. I mean, can I track my miles to the airport and stuff like that? And we'll talk about this trip a little later because it ties into charity work. But, can I track my miles to and from like the airport or something like that?
Well, they paid you. So it's business. So you actually eat.
They didn't end up paying me. They paid for my expenses.
Okay.
So
it'd be one of those things where what they pay you be revenue, and the cost you had to be expenses. Net effect 0.
Okay. So you can't.
Well, I mean, again, is the intent to do a cool project and have some charity work, or is the intent to build, like, it's not really building your business? If you did some charity, like this one for them for free in hopes that you could do others, and there was like an ongoing business relationship or something, then but generally speaking, if you're doing charity work and you're not getting, there's no revenue opportunity for it, then it's kind of...
You can't really write that off.
If you're doing it for business, that's when the mileage will be at like 57.5 cents per mile. If you're doing it because you have a big heart, it's 14 cents.
Yeah. So you could definitely write out 14 cents.
14 cents a mile. Hey, I'll take what I can get sometimes because I've had to pay taxes a couple years and it sucks sometimes. So what's up with cars? Someone had said they had bought a truck and they write it off, but they use it for a business purpose. Like, what would be a general rule with buying a car for your business? Like, if you're...
Okay, like, so you are always hauling gear around.
Yeah.
In a big way. right? I mean, you've got 17 cameras in here.
17 cameras.
So for you, like, I mean, like, let's say, like, there's a pretty decent, I mean, you could use a truck, right?
Yeah.
But there are certain cars that get better, faster write-offs, I should say, right? Like a truck, if you buy in a truck, you can write off certain types of trucks. Not every truck has to be big enough and meet the criteria, but you could write off up to 100% in the year you buy it.
Okay.
But then you don't get anything the following years, right? It's like you're just basically accelerating it. You're getting it faster. So that's why a lot of like business owners will buy like big trucks at the end of the year if they're having a really great year and they need to lower their income so that they can get that. And they already need a truck anyway. We kind of talked about that earlier. Then they'll do that so they can write off that. Now it's based on how much you drive it for business still. So normally you don't write off 100%. You normally write
There's
off some
limitations,
portion.
maximums
Right.
on vehicles. I think it's around 20,000 for the first year that you can take off.
For the SUVs,
Over 6,000 pounds.
For trucks, you can do up to 100% still of the write-off, but it's based on business percentage. I would never do that because then you might trigger an audit. But, you know, I did mine. I wrote off 85% of my truck in the year that I bought it because of the truck. Not because the trucks fall under one rule and the SUVs fall under other rules. So.
And then even if you're financing the truck, you can write that off or something.
You have the interest, yeah.
That's good to know. I'm going to get me a truck now, finally. I've been driving a Prius like a sucker. I just thought...
And get a truck so you can haul your Prius around.
Exactly. So I'm going to... Hey, Cybertruck's coming if I do $100,000 in sales or something like that, right?
I think the Cybertruck's going to weigh enough at 14,000.
Yeah, I think so. Okay. So this one kind of goes into something that we've talked about, but there's a guy who travels a lot, but he'll go with his family, but he also takes pictures for a client, like he does gear shots. And his question was, when he's on a vacation, like if he'll go with his family, I use Hawaii all the time, let's say Iceland, and he'll put a backpack out and take photography shots. He'll bring those things with him on these trips. Is there a percentage of that trip he can write off? Is it like the day of when he's taking those pictures, or is there...
Would he be going on that trip if it was not a vacation?
What's the purpose?
Like, is Iceland necessary for, like, is the backpack called the Iceland and needs to be taken in Iceland? Do you know what I'm saying?
Possibly.
Yeah. It comes back to the intent. If there's a reason he has to be in Iceland to take those photos.
Yeah, if the person that's hiring to do that job said, this is where we want it done.
Yeah.
Then yes.
And he decides to take his family on that vacation.
Yeah, that he can take his costs, like we mentioned earlier.
Okay.
But if it's just like, hey, you know what'd be really cool? Iceland. And I can take these pictures here, then probably not.
Well, I think he also does both. Like he kind of takes advantage and, to have great client relationships, they need social media content and things like that. They give him a lot of gear that he wears all the time, and he's like their model. But he's a buff dude, but he's also a video guy, camera guy, and photographer, and he'll go and get pictures in these exotic locations of himself, of all these things. And
if that's the service that he's providing, and that's the clients want exotic photos of this stuff,
yeah,
then there's a great argument for that. But if it's just like if that creative discretion is left up to him and that's not being sold as that, then that would be a different scenario. It's basically, does it match up with what's the requirements are, like you said, are the requirements?
Would they get paid anyway, or just would it affect with their revenue stream in any way? If you did it up in the Rockies somewhere outside their in their backyard, would you still get paid for that?
Okay.
But if he's selling it to that client and saying, look, I do exotic product shots. I'll get your product shots in like really, and I'll do 50 social media posts for you in Iceland, and it's sold that way, then he has to deliver that. So now it's ordinary and necessary for him to go there to provide
It's part of the contract.
the contract.
Yeah.
So you're starting to see a loophole, right? If you can write your contracts correctly, you can unlock a bunch of other stuff.
So talk with your accountant about some of that. Car insurance, is that part of it if it has to do with business?
Those are the actual costs. We talked about this, the actual cost versus standard cost. The standard mileage rate is already included in that.
Okay.
While the actual costs you can include in
So
that.
if you're just tracking your miles, that's all included within that.
Yeah, your percentages, which was mentioned earlier. If you 60% used for a business, 60% of the insurance can be taken.
Okay, cool. So track your miles. If you're a filmmaker, actor, writer, traveling to auditions, can you track your miles if you're going to go to a movie? And
Again, it comes back to if that movie is deductible,
okay.
then yeah, you
A
can.
deductible movie, I should
Yes.
say. So traveling to movies, travel to auditions, travel to your films, all the movies that you're making. So now let's segue into the home office. Now we're going to talk about home office. Did you know you should be writing off some of the square footage that you've been using for your home, for your business? If you didn't know that, let's talk about that. So how much space can you write off?
Every single inch of your home.
Every inch?
Not. You cannot do that.
If it's an office building.
Yeah, yes, an office building. Yeah, exactly. It was interesting because I was an IRS auditor years ago, and we would actually, one of the things we would look at is office use of the home. And one of the things we'd have them do is show us pictures of their office in the home to prove that it was actually, they had an office in their home. So technically it's supposed to be, that area is supposed to be 100% used for an office, which it's almost impossible to do. But you can still do it if the majority of it is still used there. And make sure if you do take pictures, your pictures are taking the right angle. No personal stuff is showing up. But as mentioned earlier, if your house is 2,000 square feet, you're using 200 square feet, 10% of pretty much most of everything. There's a form, IRS form, that you actually can fill out. There's the mortgage, 20% of the mortgage interest. There's property taxes, insurance, utilities, repairs. And the repairs they could maybe of the roof, but it could actually be taken, and other things, landscaping. So it's really, you can really go, you can go hog wild.
I just repaired my roof last year.
If we like, my partner ran the numbers on this, and on a pretty moderately priced home, if you do the home office right and you're legit and you're really running a business from home, then a home office could be worth up to $15,000 to you in cash every 5 years.
Really?
And you depreciate the house as well.
I didn't even know.
You can take the depreciation part of the house as well.
But a lot like he said, it's got to be used exclusively for business. It's got to be your primary location where you run your business. So if you have a film studio that you go into, and it's not where you do your work.
My office is my edit bay, and I have a room that's dedicated for that.
So you'd be fine in that scenario.
So
I've seen your office.
Yeah.
You might need to get rid of a few of the personal things, but
Get rid of all my personal stuff in there. Well, some of these things I didn't know, so I will do that now.
I'm just kidding. I don't know if they're personal. He has a lot of knickknacks, but they're probably from movies.
They're props.
They are probably props.
Props from movies. So right now I'm building a home theater in my basement. And just little by little, it's going to be this home theater where I want to take clients. Like if I'm doing a project, I hate showing it on my computer screen. I'd love to, put things in, and I show things to clients. Can you write off that space
That's a very gray area. I was really hoping you weren't going to ask this question.
Can you write off the cost it takes to make that?
It's a little bit more towards black than gray.
Yeah.
Okay.
It's pretty much, it kind of goes back to if it's 100% used for business or not.
You can't even write off a percentage of that.
I mean, if you wanted to calculate how often that room was used and track it,
Yeah.
and show how many times the
had
door was
clients
open and
over?
your kids were in there versus how many times you had a client in there,
Yeah, good luck. Yeah.
then you could probably make an argument for it. But by the time that really happens, it's probably not going to be worth the cost. I mean, you might save $100, but
Yeah, wouldn't be much at all.
Okay.
if you built a second movie room and you only use it for that, then you could write off the cost of that one.
Okay, there you go.
I could tell my kids they can't use my home theater.
Yeah.
You can't use this. This is just for me to study films that I rent, and to
You've got plenty of room. Your house is 10,000 square feet. I mean, just take a little small 1,000 square feet and you're fine.
Yeah.
Here's the thing to remember, though. Who has the burden of proof to showing how much that something is used for business?
Yeah.
You do. If you can't prove it, the IRS takes it away.
Yeah, you're
really?
guilty and prudent until proven innocent.
Doesn't take away your home theater, takes away the deduction.
Which may put you in a place where you'd have to sell the home theater.
Dang it. I go to jail. All because of your home theater.
But that's the important thing to remember is you have to prove if you're claiming a percentage of something like your vehicle, you have to keep the mileage log to prove that it's otherwise. Otherwise, if you can't prove it, then that's when they take it away.
If it wasn't written, it wasn't done.
Yeah.
That's good. Darn it. I was hoping you'd give me some better news on that one.
Sorry.
No, that's okay. So
If you started charging tickets and turned it into a little like movie theater, maybe.
my neighbors. How could I rope my neighbors into this? What if I use it as my multi-level marketing? Like, come in, and then in the end, I'm giving a presentation to my neighbors.
Next question.
Okay. Just like you need some friend advice because you're not going to have any. Writing off hard drives, if the hard drives are, so when you have hard drives, should they only be for a project and you can't use personal stuff on there? Obviously, the IRS isn't going to look in your hard drives, but.
The IRS is going to give you a notice when you're going to audit you.
Take off all personal stuff off a hard drive that maybe you had.
They're not going to be looking at those types of things.
Right.
You
Okay.
know.
But you can write off hard drives as an expense,
Absolutely.
right? Internet costs of the home you had talked about.
That's an interesting one because I had a client that was audited and has his office in the home, and I went with them to the audit. He had his cell phone and an internet, and they actually disallowed those because he would have those anyway. At least the cell phone. The cell phone is 100% written on. They disallowed that.
Oh, wow.
Some of the internet we were still able to take.
Okay.
But still, that's that percentage again.
You have to have a small, because
That's
like I
interesting on the
use,
cell phone
Yeah,
one.
it was.
I got fiber now, and I've been using that to upload a lot of my stock clips and a few other things. And I deliver, anytime a client asks me for a DVD, I don't ever want to work with that client again. It's like I basically, I'm just kidding, but like I deliver either through Dropbox or Google Drive, just the final videos and just digital. So I use it a lot. So I guess you just have to determine the percentage of how much you use the internet.
No, it goes back to square footage of your office space.
Yeah, office, yeah.
Yeah.
How like in my case, like I guess I'm a little confused.
So how many square footage is your house?
3,900.
How many square footage is your
I mean
office?
10,000. The McGraw estate.
How many square footage is your office?
My office is probably 200, 250.
So you're talking 5%.
5%.
So you can write off 5%.
So it's based. So the however much you can write off is based on how much in your the square. Okay, I didn't know that. So okay.
Yeah, and with our client, we didn't push the phone thing very hard because he had other things.
You were just trying to like get
We
a
were
settlement
like,
and go.
look over here, look over here. Don't look here, don't
Just
look
sign
here.
the dotted line, pay $500 and move on.
Exactly.
So when coming to you, I still bring my internet bill. I give you my 250 square foot of my office of where I do my editing and all my client work.
Hey, if you're just getting me invoices, your price is going up. We want you to do some of that work too. No, but yeah, you total those costs up.
I total the costs up of all. I expense it maybe through Taxbot, and I have it be like. Is there a category that
So
you
there'll
would
be
put?
like home office utilities,
Home
and then
office
it's going to have the
utilities.
totals. He's going to calculate the total square footage of your home, and then he's going to reduce or
Then
take
he'll
just the
reduce all
percentage of that.
So that's when we bring stuff to you. Okay. Are you able to write off advertising costs and like deducting the cost of business cards, taking photos for use in work, like I don't know if you're making a reel, what that cost would be to like advertise that on Facebook or sending things out like postage and stuff. Would that be considered an advertising? Should we
Absolutely.
break those up?
Nope, everything's the same.
Yeah.
It's all advertising.
Yeah.
You can write it all off.
As long as you have a business purpose.
Yeah.
So like a web page, I mean, that's considered, exposure, right? If someone hires you and you don't make any money, but you get exposure, can you write off the trip to that or whatever?
That would be go more like to the travel, right?
Yeah. Okay, a website, Blogspot, all that stuff you can write off under advertising. If it's helping your business, there's not a lot of questions here. So is it worth itemizing all these detailed expenses with the new tax laws that create a fixed deduction? Or do my expenses have to supersede the fixed deduction in order to make the effort worth it? I don't know what someone wrote that. I gave this Google Doc to a lot of friends.
I mean, I'm kind of interpreting. Maybe you.
Yeah, I didn't quite understand it, so go for it.
I think what he's saying is, I think he's going back to the discussion of he's not sure if he's a business or not, and so he's like, should I set up as a business and write these off, or should I take these as itemized on my personal tax return?
Okay.
And again, so again, he's a business. He just doesn't know it, so he should be writing them off.
Yeah, because you have expenses associated with your employment,
Right.
and that was those expenses were taken on a form 2106 in 2017 and prior, but it's gone. You can't do if you did travel or you went to if you weren't reimbursed for things from your employer, you could actually take those on as an itemized deduction. Those are gone.
Okay.
That's why we talk to a lot of our clients is to talk to their employer to get it fully reimbursed, and that way it actually decreases their wage a little bit, and they actually still would get the deduction in a round the back way.
So all advertising is a write-off. Like if you were a filmmaker, what would be some of those things that you would say, I would make sure that I'm getting this advertised and I'm writing that off?
I mean, if you're spending money on getting it in front of, anytime there's $1 spent trying to get promotion or get exposure for that, I'd be writing that off.
All your Facebook,
Every Facebook
posts,
ad,
every
But you're wanting to make sure at some point in time you have revenue.
Yes.
Just-
That's a good point.
Yeah, because you might be just starting out and you have all these expenses to promoting yourself, marketing, advertising, getting a website. You're doing all, spend maybe tens of thousands of dollars to do all this stuff, and you make zero, and then you decide to decide not to do it. You can still take those things because you were started it out to do it, but then you decided it was not worthwhile, and then you walked away from it.
Okay.
But if you keep doing that year after year after year, and there's never any revenue, that's a problem.
Yeah. Then they're going to be like, this guy needs to be
That's the hobby.
institutionalized. And
Yeah, that's when it becomes the hobby.
yeah, exactly.
So advertising your CD or something or anything like that. Okay. Agency fees. Someone added this. I didn't see this one. So an actor has to deal with agency fees. So they'll work on a project, and sometimes that's tacked on and sometimes it's taken out of how much money they made, So they'll go do a half-day shoot, and they may make $600 or $400. Agency will take 10, 15% of that. Is that considered an expense, to travel to and from their offices? Should we be writing that off?
I would.
Okay. All agency fees, stuff like that. Okay, good to know. Moving on to gifts.
On that though, you would pay. You would only take like if you got the $600, they took the percentage out. Say they actually received the $500. I would just put the $500 as the revenue and not even worry about the $100 they kept.
Correct.
Okay.
Unless it's traveling through your bank account, right? Like
Yeah.
unless they're like depositing money and then you have to reimburse them their fee, like you pay their fee back to them or something. But if there's no paper trail like going through your bank account, I would probably just, like he said, take the revenue.
Yeah, because what the whole thing is most individuals, 99.99% are on a cash, what's called a cash basis.
Okay.
So whenever you receive cash or pay cash, that's when it becomes revenue or an expense.
Gifts. So sometimes you give gift cards as thank yous and stuff like that to your clients or someone who may have done free work for you. So if someone has done free work for you, you give them a gift card. Is that considered payment? Or is that depending on the side of the gift card? So like Because sometimes I've done that, but then
The thing is, you were not required to give them that gift.
Okay.
That was you did that as a promotion for your company.
Yeah. Okay.
Thing is though, the gift technically can only be $25.
Okay, $25 is like the max.
Yeah.
Of any gifts.
You can
And
give them
not
more,
even a
but you
gift
can
card?
you can give them more, but you can only deduct $25.
Oh.
True.
So you can give them a $10,000 camera, and you can only write off $25.
$25.
And a married couple,
goes to your
and a married couple counts as one person.
a married couple counts as one person.
But here's a little trick though. Something that's really interesting. You have to be. I mean, it has to be legit, right? But gifts to organizations do not have the same limit. So, if I were to send a gift basket if I were to give you a gift basket for $500, I could write off 25. But if I was to give a gift basket to Lucas McGraw Productions Company, then I can write. Then I'm not subject to that $25 gift.
Really?
But how do I prove that?
How do you prove it?
I would be taking pictures of like my gift, my note that I'm sending, say 2 of the best productions or whatever.
Yeah, 2.
And thanks for your whole
community
your
film projects.
whole team did an amazing job for us. We appreciate your business.
And that's one advantage of having a business. You actually have a little bit of flexibility in some areas.
Okay.
As a sole proprietor, that might be a little
gifts you
harder.
could write off the full gift if you're from a business to a business
Or an organization.
or an organization. I didn't know that.
I mean, obviously, if you're going to give them like $15 million or something, they might not like approve that. But
That's awesome. That sounds like a good way to launder money a little bit, isn't it? Not saying you should launder money. So, okay, that's all we had for gifts. Is there any other things that we should know about gifts?
No, I think you hit it good.
Okay, free and speaking of gifts, let's go into free and trade work. I've done a lot of free work, and I've done things for exposure, and let me give you one example, and this goes back to the trip I took to Peru for a humanitarian group. I've always wanted to go to Peru because there's this place called Machu Picchu. If you haven't looked it up, it's amazing. And I was 30 years old at the time. It was like, I'm turning 30, I want to go, and they offered it to me, but they couldn't pay me, but they could pay for my expenses as part of this trip, you know? So they'll take expeditions down, they'll take high schoolers and all this stuff, and I was gonna make a promo video for them in exchange. But they had said to me, it's like, keep track of all your hours, keep track of everything, and I did. Kept track of everything, and at the end, they're a 501c3. At the end, I got a form from them that said, this is how many hours, and this was the amount of time, because like based on how much I charge, this is how much you donated to us. And I took that to my accountant, and he just kind of went, you can't use it.
really what you should have done is taken that to your parole officer for your community service hours, and that's what would have helped.
Really?
Well, $10 doesn't go very far though.
Yeah, I really should charge more for my community service. But
The whole idea.
so if someone comes to me and promises, so that was like kind of disappointing because my accountant at the time was just like, you can't write that off. You can't write off your time. You can't do that. So
Yeah, because no money was exchanged.
no money was exchanged.
Because
it has to be money.
What they do, a nonprofit, they receive in kind.
Yeah.
And we do a lot of work for a lot of nonprofits. They want to build up their in kind, and it becomes the people that help them promote their business. Say it's $100,000 worth of work. They put that as a revenue. But the thing is, then it turns around, it's an expense on there, so it zeroes out on the nonprofit, zeroes out. But when they're going after sponsors and contributors to their purpose, they say, look what we have. We have this in kind from people from the community contributing their time and effort of $100,000, which promotes their business that much more, which increases their opportunity to receive donations from other outside sources. That's really their main purpose is behind it. From a tax standpoint, if really what would happen is if you want to take that as a tax deduction, you have to first include as revenue, and then as a tax deduction yourself as well, because you in essence earned that,
Okay.
and then you're getting the deduction for it as well. So that's why your tax person said, just it zeroes out, and don't worry about it.
Okay. Well, I was thinking that year I had done some other stuff. I was like, I could write all this off. This is going to be great. I got to go see Machu Picchu. I actually hiked Huayna Picchu, the hill, and then came and did this promo video for him. And then when I got home, he just looked at this little form and he's just like, I can't do anything with that. So if anybody tells you that or tries to sell you on that, learn from me. Although the trip was amazing and I was helping a good cause.
It was very well worth it.
If there's no money exchange, there's very rare. I can't think of any situation where it's a deduction.
Yeah, but like I was doing something for a local charity here where they had approached me with that kind of, hey, you can write off your time But they
you
said,
can write it off, just not on your taxes.
Write it off from your employer as PTO.
Or just kiss it goodbye.
kiss it good, I'll just write it off. But they basically said, well, this other guy who works at this place, or maybe a bakery, donates this bread. So if they're donating actual things that cost them money, then they can write off the expense of that.
The cost of what it made to make those donuts or cupcakes or whatever.
Okay.
Yeah.
So, all right. And they're like, they do that, you can write off your time. And I was like, well, I've been in this situation before and I don't think I can. So can you work out any deals when can you donate time, or is time just off the table?
It's off the table.
Okay. So let's talk about trade work then. So I've had friends that say, I'll give you, like I did a thing I was getting paid, but my friend his business, so they basically paid me on the side, but my friend with his business was doing a trade. Yeah. I was working for a kitchen and cabinets and countertops company, and he was getting a new house and he was getting all new countertops as part of his business, but they did it.
So bartering.
They were basically bartering, so they did a trade. How would that be written off? Like, should you be tracking that? Like, I mean, is that
Most,
a way to
I just
get-
tell you, most do not. There's actually businesses out there that just deal with that, this
Really?
bartering. And if you have something, you can tell them this is what service I have, and there's something else over here that I want. And there's the bartering companies out there. But the main thing, and then technically you're supposed to issue a 1099-B.
Okay.
Is what you're supposed to
I don't know
do.
what that means, but
It's a like a 1099.
Yeah.
But that B means it's bartering. So if you did an exchange with somebody that's worth $1,000, you're supposed to issue a 1099-B
So you'd each
to each other. Yeah. Then that person is supposed to report that as income, and that's usually how it goes. But it doesn't happen. Hardly anybody does it.
Really? Yeah. And if you got audited, could you be in a lot of trouble for that, or?
Is there a paper trail?
Okay, is the camera still going?
Yeah, the
They're not going to. Nobody's going to see it. Really? If it's a small amounts, it's not that big of a deal.
Unless you're like writing notes in your accounting software that says I'm doing some trade work and stuff, like it's going to be kind of off the books. And if it's labor for labor, right, or whatever.
Because I've got a shed company that said they could give me a shed. So it's kind of a good deal, right? Like I'm not writing it as income, and I'm not unless you're not.
Yeah, technically you're supposed to put it as income because that's what you'd be charging. Say it was the shed was $5,000,
Yeah.
and you technically should be reporting that as income.
So they 1099 BU for $5,000, and then you would write off your expenses against that.
Yeah. Oh, okay.
So it's just as if they gave you $5,000, and you could buy the shed from them. It's just.
The money just didn't change hands.
So then you would just like your expenses, like your miles to drive to get the thing. Okay.
Just regular business stuff. Yeah.
All right. So here's another one. Utah Film Center allows people. This is a great little thing. If you're making a feature film documentary or anything, you have to come up with a budget, and you have to come up with like a schedule, and it has to be a detailed thing and get approved by the Utah Film Center. But they're a 501c3. And they allow people to raise money using their status, right? They take 5%, but raise money for a film project using their 501c3. How would that show up? How would you track that on your taxes? So say I did $100,000 in raising from businesses that donated to my film. 5% goes to them. Is that considered revenue? What is that? Where does that fall? Because if I'm going to be using that just to make my movie, Like I guess I'm just it's fuzzy for me.
Yeah, that because the 100,000 is going to them, to the nonprofit, and so you're getting 95.
95.
The 95 is what you track. You don't worry about that 5 because
Okay.
that's theirs.
And that's not
Because
considered an
that
expense or
100,000 is their money.
Yeah.
Because it's contributed to them. Even though it's on for your behalf, it's still their money
Okay.
until they give you the money.
So in that scenario, this is a little bit different because it's obviously we're talking nonprofits and stuff like that. But and I know you deal with this, but would that be essentially they've raised that money for him to go produce a film? That money would not be necessarily because they're not owners in the company. Is that money considered revenue to them?
Yeah, yeah. They're,
Because if I asked you for $95,000 and you were going to own part of my production, right? There's that's not revenue. That's an investment raised.
Yeah.
But
they're not owning.
But they're not owning the production. So is it revenue? Is it considered revenue?
Yeah, because because the nonprofit is given to them as one of their projects. You receive that money, so you got to do something with it.
Yeah.
Yeah, or are they going to have a percentage of the revenue, or are they not involved at all? They
They're
give
not
the money, they're
involved. They
done.
allow you
Yeah,
to
that
raise
95 becomes revenue.
That becomes revenue, but then you expense what it costs to make the film.
Yep.
Okay.
But if it takes you too long to make that film, you might have to claim that revenue in a year
In a year's
that
time.
you don't have expenses against it. So you might lose it if you don't use it fast. You might.
Or just do the timing so you can do some draws and timing the draws out as opposed to getting all at once. That's a very good point.
Time the draws out with them. Maybe.
Yeah, because let's say they do it all, they get all the money, and in November they give you all $95,000. You're not going to be starting filming till January.
Yeah.
Then you have to claim all $95,000 as income for that year, pay taxes on it. So now you're only left with
And then the expenses don't-
$60,000 for next year to pay for the.
Yeah, just be sure to time things right because you can get burned on it.
That's when you buy the production truck.
But if it was an investor,
That's when I get Cybertruck.
if you had come to Scott and he had invested then and got ownership, then it would be he's making an investment. That's not income. That's capital raised, and there would be no taxable event there.
Okay. That's good to know. So like raising money end of the year, even if you're raising
Ownership, investments, putting money into an investment, there's no taxable event. So if I own something of it,
Okay.
right? If I'm making
Or
an
a
investment,
loan.
or a loan, yeah, that's a good point. So loans or investments might be more beneficial if you're not, depending on the scenario, how quickly when you're going to raise that money and when you're going to film and produce.
That's funny. Like none of my filmmakers asked any of the questions about investments, which is a huge thing. I mean, you have to get investors. I mean, film is a collaborative art, and it requires, hundreds of thousands to millions of dollars to make what Hollywood is making. And you think you can make something cheap on the side, but usually, sometimes you can, and there's a fluke out there. Sometimes, I think Napoleon Dynamite costs like $400,000 to make, right? But it's still
Still $400,000.
still a lot of money. Films take a lot of money, and it's hard. You've got this art. It's not just like painting a painting. It's like you have to get a whole bunch of things in line. So that's good. Any other things about investing that we should know?
Only invest in the ones that make you money.
Buy low, sell high.
Yeah, there you go.
Well, to get investors, technically it is a business. I've always been told, you just have to basically tell people how they're going to get their money back, and then you usually have a higher chance of getting someone to invest. Every once in a while, you might have an angel out there, but that's just don't count on it. So hiring people and invoicing. When you're doing invoices, are you suffering tax-wise if you're not charging tax on those invoices?
Like sales tax?
Yeah, is there like a sales tax that you should be charging?
In this industry, I'm not 100% sure, but I don't think there's sales tax involved in this industry. Only when you have a product
Yeah.
or
Usually the
a
services
tangible product, like there's sales tax associated with this.
Okay. Okay, I didn't know
But there
that.
would-
So that's one thing that's like.
When you first set up the company, you with the state, you let them know if you're going to have employees, there's going to be sales tax and all those types of things.
Yeah.
And so in this case, you'd say no, and then they won't bug you to try to get sales tax from you.
Oh, okay.
And remember, sales tax is a state issue, not a federal one. So there's no federal taxes, but it would depend on state. Like if you're in California, it wouldn't surprise me if California taxed services like that. I know,
especially in the
right, in the movie industry, right?
Okay.
They were going to try to tax some services here in Utah, but that just got repealed. So,
I always thought, I'd go to like my mechanic or something, and I would get something, and then you see that they would charge a little bit of tax, and that could be for the products that they added. I didn't know that there was a difference there. I was like, should I be in charge of this? Is this going to hurt me in tax wise?
Because what happens is like a mechanic, they buy like a alternator, and they don't pay sales tax on it. They buy it, and then they put it in your vehicle, and then they charge you sales tax for it. Okay. Somebody has to pay sales tax on that item at some point in time.
So if I'm selling merchandise, though, like if I do a movie or a movie poster, I should be charging sales tax for those things. Could I be getting in trouble if I'm selling them online here in Utah and I'm selling a whole bunch of merchandise?
So sales tax is a really weird issue. Going through a lot of change right now. But physical products and like that generally depends on whether or not you have nexus in a state. So, like, for example, I sell Targets online. I pay sales tax anybody I sell those to in Utah.
Oh, really?
So any one that ships to you in Utah, I pay sales tax on. And other states are trying to pass laws that there's a big issue of they're trying to pass laws that cross state borders, which is a federal issue.
Yeah.
But like, there's this big battle going back and forth. So I think probably down the road, 10 years, then you're going to probably have to charge sales tax everywhere.
Except for Montana. They still don't do sales tax there.
Except for Montana.
All right. I'm going to live in Montana just for that.
But I wouldn't be surprised if New York tries to claim sales tax for Montana.
Well, that's interesting. So, yeah, like we did our feature film, and a lot of times we'd show up and we would sell merchandise. And so I don't think we charge sales tax on any of that. I mean, I don't think we...
Your friend did a project once.
My friend did a project once.
Didn't charge sales tax.
But, I mean, maybe they figured that out when we got audited. I know we had to pay a few things to do things. So we're square. We're square. But, yeah, that's good to know. It's just as you're making your stuff in PayPal to add that sales tax part to merchandise you sell.
And each county is a little different. You got to know where the county you're in as to what the sales tax is in that county, where you're based out of.
Oh, really? I didn't know that. I thought it was all the same for Utah.
Utah has a sales tax, but then the counties they throw theirs on top of that. Yeah.
In your pocket every step of the way.
We told my son about taxes because he wanted to buy a video game. We helped him raise money for that. And then we're like, oh, you have to make a little bit extra money. He's like, what? We're like, it's for taxes. And he's like, taxes? And he's like, taxes? It was
Now
funny.
you're starting him out right already.
Yeah.
I hate taxes.
He was about ready to go dump some tea in the harbor there. W-9s, every once in a while you'll get, as a filmmaker, you set up teams and you have to pay people certain things. I was told once from an accountant that, stuff that's lower than $500, you probably shouldn't have to consider that as paying
anytime I hire anybody or do anything or somebody's going to do anything for you, get one.
Get a W-9 from
W-9, because you never know. Later you might use them again.
Yeah.
And you're over the $600 threshold to do issue 1099s, but it's easier to get the W-9 at first, before the fact, before you pay them, as opposed to after you pay them.
But even if you don't use them again and you paid them $250 for a quick little thing, you still have the W-9, but you don't have to have that. So there is a threshold, you're saying?
For 1099s.
For 1099s.
W-2s, I would anybody I use, I would do an I-9 and a W-9.
Okay. So you told me this, and that was the advice I got, is like always get a W-9. Don't pay them unless they give you a W-9. And that's kind of a good rule of thumb as you're putting together. You get invoice. You just send me an invoice and a signed W-9, and then I'll pay you. And I mean, what happens there? I don't Again, I am such a novice when it comes to this. Even doing stuff with you and making all your Taxbot things and using the app, I just don't even understand what happens with the W-9. Working with you, I give you all my W-9s and my invoices, and this is how much I made, and this is how all the people that I paid. What happens with that?
Yeah, we look at it and see who is overpaid $600 or more.
Okay.
And then issue a 1099 to those people.
Okay.
And then they have to pay taxes on those. They're supposed to be taxes on it anyway, but you're only required to do it over $600 or more.
This is basically just a program for the government to track money, right? So if you pay somebody over $600 or whatever, over $600 as an independent contractor, and you don't issue them a 1099, the government has no record of them receiving that money.
Okay.
So they can't tax them on that. So it's really so they put the burden on you and say, you have to pay those, and if you don't, they're going to come after you.
Okay.
So it's really you're the person you're paying that money to. If you don't have a 1099, they could essentially cheat on their taxes, not report that income, and they're not paying taxes. And then
it comes back to me.
But it could come back to hurt you.
Yes, if you're audited, they can actually take that away from you, that deduction, and also $50 per 1099 penalty.
Really? Interesting. So get the W-9s. And do we need to be paying self-employment tax? Where does that fall in? That's a question that somebody had written.
It depends if you make money or not.
Well,
If you have a profit.
like, if you're not set up as a business, are you paying, like, I guess, where does that
Let's define
fall?
business first, though.
Okay.
Yeah.
Everybody's a business. Whether or not you're an entity is the difference.
Okay.
Differences, right? If you're a LLC versus an S corp versus a C corp versus a sole proprietor, those are all businesses. Even if you haven't filed articles of organization with the state or something, you're still a business. But the entity determines like a bunch of different things that you have, the way you pay taxes, I guess. So, like if you're an LLC, you technically cannot receive a wage from your LLC.
Oh, really?
Right? You get paid because everything that it makes it, or a member of an LLC cannot receive a wage. They get it paid as a guaranteed payment. It's a little bit different. I mean,
Well, it depends.
Yeah.
You actually can be a wage earner.
And we'll talk a lot
Can you really
about,
now?
like,
Yeah.
we'll talk a lot about businesses when we sit down with you and we learn more about businesses. I guess someone had talked about self-employment tax and I was a little confused.
Yeah, because
So
the
if
thing
you're
is,
an LLC
like you said,
entity-
if they don't do anything, they're a sole proprietor, no matter what. If they decide not to even start a business, but they made some money, they're a sole proprietor by default.
Okay.
And it goes on to Schedule C on the tax return, and you have your revenue and expenses. Then you pay self-employment on the profit.
Okay.
So if they received $5,000 and had expenses of $3,000, they pay $2,000 in 15.3% of that goes to self-employment tax, which in essence is Social Security.
But if you're an S corporation, you can get a salary, and you're having taxes withheld and things like that. So it just changes things up. But you just get with your accountant. That's great.
There's some good tax planning that can take place with that type of entity that you want to do.
So by the time this video is released, we probably won't have the other video ready, but if you're watching this years down the road, we're going to have another video with Scott. We're going to have another video with Scott, just kind of defining what would be the best business entity to set up for what you do. And we'll get into that a little bit. So one of the questions is, when a good time to start a side business, benefits, interests? Like, is having an actual entity set up a lot better than just going out and doing it all on your own and just being a sole proprietor? I guess it just depends on your needs.
Yeah. If you're having losses, don't spend the extra money to go out and set up an LLC and get it registered with the state and all, get an attorney involved or any of that stuff. But as soon as you start making, we tell our clients if their profit ends up being around 10,000 or more,
Okay.
we need to set up an entity for you so we can start saving taxes.
The other
10,000 or more.
The non-tax spin on that is if you're doing things as a sole proprietor without an entity, and you're doing something and you get sued, that's the difference. Because your business would, if you have an entity, your business gets sued, not you personally.
Oh, okay.
If you're a sole proprietor, then you get sued.
And you and your whole, they can come after your family, basically.
Right.
Oh, yeah, that's good to know.
I lost a kid that way.
That's how you got in the business, you know? Here we are with some random questions. We're finishing up here. Rapid fire. If you buy a suit that's purely for business meetings, can you write that off?
No.
Health insurance.
Yeah. Kind of. So here's something interesting. I know you're trying to go fast, but
No, you don't have to go fast. You can.
okay, so there's a provision in the tax code that allows certain businesses that qualify to set up what's called a health reimbursement arrangement. I love these things. Most people don't know about them, but you can. It's been in the code since 1955. But if you are a small business, it's just you and basically you, right? If you can, if in most cases, if you can find something for your spouse to do in the business and hire them as an employee and pay them minimum wage, you can set up what's a health reimbursement arrangement, which basically says that you're going to pay for all of your employees' medical expenses not covered by insurance as a business expense. Okay. And then the company reimburses them. Now, the reason it only works for small businesses is because can you imagine a big Fortune 500 company saying, we're going to pay for all your medical expenses that are not covered by insurance? It doesn't really work, right?
Yeah.
So it's really meant, they really originally did this for farmers and small family businesses, but you can set it up. It's called an HRA. We have more information about it. We have a website, taxbot.com/HRA.
Okay.
It's a really cool thing. Not everybody qualifies. We have a little quiz there that kind of helps you see if it might work for you. But other than that, outside of that, you get to write off some of your health insurance on your personal taxes, not as a
Yeah, it doesn't go on your business return, even though the business may pay for it. Right. It flows over to the front page. Well, tax returns changed a lot. Right. It becomes a deduction, but not a business deduction.
But if you can qualify for an HRA, it changes it to a business deduction, which is cool because then you save an extra 15% on self-employment tax. But it's again, taxbot.com/HRA if you're interested in learning more about that.
I'm interested, actually.
I personally you especially need one because you all the medical expenses with your family.
Yeah, I have a daughter with special needs, and so I'm going to look into that. That's interesting. I didn't know that. I thought for sure health insurance, no. So that helped me out.
There's some qualifications there, right? Like if you're not getting paid, if you're paying for it, it's like if you have another employer that's paying for it, then no.
Okay. Here's a random question. A friend told me that his accountant had
one of those again, huh? I have a friend of a friend of a friend.
A friend told me that his accountant says that if you bring your kids on set with you, you can pay them or write off about up to $3,000 in a deduction. It looks like you're about to come and laugh, but I don't even know what that is. As an assistant type thing. If I'm going as a photographer and I'm having my kid help hold a light and stuff like that, I can every year technically write up to $3,000 off with my child.
But your child has to report that as income on their return.
The child has to have a return too?
Yeah, because they're earning money, so therefore they're receiving cash, technically. Yeah. So they should be paying taxes on that. There is a benefit if you're a small business, you do have family working for you, kids. Yeah. If they're under 17, you don't have to pay Social Security tax on them. Okay. Self-employment tax, which is a benefit. But once they get to that age, then you have to treat them just like anybody else. And you have to really pay them what market value is. So if I have my kid be my assistant for 4 hours, I'm not going to pay him $3,000 because if somebody down the street does that, I'd be paying them maybe $15 an hour or whatever. So I need to pay that kid that, or probably just a little bit less because they are a kid, and the kid would be cheaper.
And you want to be really careful to do, like keep really good records, like timesheets and things like that of what they're doing. It is a great strategy, especially if you can have your kids work for you and do stuff and legitimate work for you.
Yeah.
And it doesn't have to be. I mean, it doesn't have to be hard work. It could be, filing paperwork or whatever, dropping off flyers on doorsteps, whatever. But if you can legitimately do stuff like that, then you pay them a wage. They have to file their own tax return, right? But there's a standard deduction of $12,000 and some change.
Okay.
So the first $12,000 of them is going to be essentially income tax free.
So the $3,000, that's just a
weird number.
That's a weird. I don't know where that came from.
Okay.
That's not.
Yeah.
He had told me that when I was asking him some questions.
So each of them could get paid up to $12,000 something a year, right? Tax free, and then they can pay for their own activities like sports and ballet and whatever. And essentially, you're writing off the cost of putting them in those activities.
That's what we did. We had an office building. We had our kids do the landscaping and the janitorial work. Awesome. We paid them, and it's interesting when you give them that money that they had to work for and so forth. They're not buying designer jeans anymore.
But you can find really good ways to pay for this. I mean, that's the way to pay for your kids' college is find a way to put them to work, pay them through that, and then you get to write off essentially because you can't write off tuition.
Yeah.
But you essentially get to write off tuition if they pay for
that
it.
in like a fund, and you're paying them.
Well, no, they would earn the money over time, just like an employee would, but then they pay for it, right?
Yeah, it becomes their cash, and what they do with it's up to them. Whether it's
They don't get a deduction for writing it off, but for paying for tuition, but you did because you paid them to do work for you.
Okay. Well, that's good to know. No. Interesting. Dawson, my oldest,
Get to work.
you get to work. So you guys have been in this business for a while. You're, should I say gurus or should I say
He's probably a guru.
he's more guru?
I'm more of a goo than a
More,
roo.
more
yeah.
goo, and then we'll have you be Rue. So what are some of the things that people just come and they always think that they can write off, but they just can't? That's just like, you just know right off the bat.
You've hit a lot of them today.
We've hit a ton of those.
Let's see. Let me think about that.
Well, we have some. We've had one. They think they can write off pretty much everything because they themselves are the business.
Yeah.
So they think anything associated with them, their food, their house, utilities, everything, their clothes, everything is a business deduction. It's because they are the business. No, doesn't. That's not the way it works.
Yeah.
You still have to live no matter what, if you have that business or not.
Yeah. That's a good one. We see a lot of people that think that because they're running a business that they can write off a lot of their expenses that we've talked about that should fall in the home office thing.
Yeah.
But they're writing off like 100% of their internet and 100% of their cable bill and 100% of all these things that are associated with their home office.
Because it touched the
Because
business.
it touched the business, they're saying that, I can write it all off. But it really needs to fall within sort of a standard of reasonableness. And in now those cases, it would be around the home office percentage, right? Now, if there's and so they try to just get a little bit liberal. I see a lot worse things on the compliance side than I do on like I'm just willy-nilly writing off everything. Most people, I think, are a little bit more scared to write off stuff than they are for willy-nilly.
Okay.
Right? Yeah. Most people are missing write-offs rather than claiming too many, in my opinion.
Yeah, because a lot of times we think, our clients think we're aggressive, but no. We're following the rules, but they just were not aware of those rules and laws.
Yeah. I mean, it's just like what your book kind of covers a little bit. It's just like, these are legal ways that you could be saving, tons of money that you leave on the table every year with your business. So
yeah, well, on that, I think the cost of your app and our fees, because of our expertise we have, we usually get our clients more money back than what our fees are. Yeah. So they're actually, when they come to us, they're actually making money.
Yeah. So I was using an accountant for a while. And sometimes I got kind of sick of it, and I just went back to like an app on the phone. I won't say the actual product just so they don't sue me or anything. But like when I was doing that, it felt like I kept, like the years I was doing it, I felt like I kept getting, like, one year I had to pay like $2,000 because I had made so much in revenue, and I guess I wasn't writing off everything. But like that hit us hard because we were trying to fix our roof. At the time, I had made about $5,000 in revenue from a gig that I did, and it was going to cost about that much for our roof. But then I got this thing in the mail from taxes saying I have to pay it within the next month, and it was just like we ended up having to go into a little bit of debt to fix our roof before winter, which kind of sucked. So there are moments as you start making money, if you're doing any of this, if you work crew, you work film, you work as an actor, that maybe you'll be making a lot of money, and you need to know these certain things to be able to write it off and you don't leave money on the table, you know. The IRS is a funny thing. They know exactly how much you owe, but they want you to figure it out. and then if you don't figure it out, they'll put you in jail. And
well, what they actually do is they will actually estimate for you, and it's not as good as if you were to file.
Oh, really?
Oh, yeah.
And so what I have found, based on my personal experience, using Taxbot app, I mean, it's a paid app, but in the end, it can save you thousands as you track all your mileage and track everything. And it's actually will help you make an audit safe report at the end of the year with all your receipts, all your miles, and everything that I would then deliver to Scott. Scott would look over something like that and would actually help interpret or know where I may be off a little bit. And there are a lot of blind spots. There's a lot of things. I'm a creative guy, and there's a lot of things that I have a lot of blind spots when it comes to taxes. So someone like that can look over, and then, you know, in the long run, you know, you may be paying, you know, an amount of money. I don't know. It depends on, I guess, the person, but in the long run, it's going to end up saving you money. So that's my concluding thought. Anybody else?
I just think that, you know, most people are overpaying their taxes significantly. And even if they're using a good CPA, because they're not using their CPA properly, right? If you just go visit your CPA once a year or your tax preparer once a year, you got to realize that they're probably you're sharing that accountant with 300 other business owners. They've got like a couple hours to work on your stuff during tax season. If you want, the best thing you could do is outside of tax season. So over the summer or something like that, go spend some time with your accountant and talk to them about what you're doing in your business. They have a wealth of knowledge of things you could do. They don't want to make assumptions and say, like, you should do this. They want to hear where you're trying to go with as a business and your objectives. They can then provide tons of color and ideas, tax-saving ideas that might make sense. If they know you're looking at hiring your family, then that opens up another little toolbox of things that they can do for hiring your family to save you a bunch of taxes. If you don't want to hire your family, they're not going to force you to go down that route. So use them, but go meet with them. It's well worth their time, and pay them for that time. Pay them for their consulting time. It comes back in spades.
Or at least take them to lunch.
At least take them to lunch. Bruce Chris if it's Scott.
Bruce Chris with Scott.
You know, on the we didn't really go over this, but I was going to thought it might be good to talk a little bit about an audit, IRS audit. When I was with the IRS, I was actually part of a task force for a while, and we went into businesses and we audited every single line item. If there was a number on it or it's check mark or anything, we audited it. And the IRS takes that information and puts in their computers and does an analysis and determine if companies in this area or that do this type of business, and they have this is their revenue range. These are really what their expenses should be in these ranges. And if they fall out of those ranges, above or below those ranges, they put a number to it. And then once you get over a certain number, it gets kicked out, and then it goes to the local branch office. Then the auditors take it and look through it, and their software actually will tell the auditors what areas to look at first. They pretty much know these are the areas. So really, having an experienced or knowledgeable tax preparer is very important that knows kind of what looks right, what feels right type of thing, and knows the industries, different industries as well, as to where you can fall in. And I had one client some years ago that was audited. I've had 2 over the last 30 years that were audited, so it's been great. And he was really worried about it. And he goes, and he's always been very cautious. And he said, well, should I be worried? And I said, well, as long as you have the documents behind it, you don't have to worry about it. So that's what an app like yours comes very handy in that situation. I have the stuff right here and support what I'm doing, and therefore I don't have to worry about it. Yeah. And it's just a big relief from a business owner to know, okay, I've got the documents. If I'm ever audited, I'm good.
That's a great point. We had a lady that just emailed us not too long ago, who she got audited, and she printed off her report. It's got all the pictures of the receipts and the mileage log that's super detailed and everything like that. She went in for her audit, and she gave them the documents, and she said the audit was done in less than an hour. And they're like, I mean, they're not looking for people who are buttoned up, right? Yeah. They're looking for people who are not buttoned up. And if you're buttoned up and you got all your documents, you really don't have anything to worry about. Yeah,
they want to make sure people are filing, they're in compliance, and then they're good. Mostly they want to make sure you're filing, and you're not taking advantage of the system.
Yeah.
Awesome. Well, thank you guys. Taxes. It's a nature of the beast. You're in the business. You're in the film business. You need to know what you can and you can't write off. Talk to guys like this guy, Jake, and talk to Scott. And if you have any questions, please comment below. And any other further things, go see an accountant. Thank you very much for watching, and please like, subscribe, share this, especially if you know someone that could really benefit from something like this. I've definitely benefited from just sitting between 2 tax goo and roo, right? But thank you, and have a good day. Let's make some money. Let's do some great work. Let's
make some movies.
Paint the town with movies.